A professional financial model functions as a highly engineered replica of a business's operational reality, translating qualitative mechanics into auditable quantitative forecasts. Building these tools to an institutional standard requires a strict six-stage development framework: scope, specify, design, build, test, and document. Moving directly to a spreadsheet without completing these planning phases leads to scope creep, where calculations become tangled and difficult to audit. During the design phase, analysts must draft a complete blueprint of the worksheets and determine exactly how data will flow before writing a single formula. This involves creating a model map, which acts as a master diagram dictating how data travels between specific tabs. Proper scoping and mapping provide the structure needed to translate unpredictable business variables into a set of auditable, manageable calculations. The construction of the model follows a principle of reverse engineering. Analysts start with the final required outputs and solve backward to the inputs. This approach anchors the entire file's integrity in a dedicated cover page or model dashboard. The dashboard integrates automated model checks to monitor data errors and track operational capacity in real time. If an underlying assumption pushes the business past its physical or financial limits, these checks provide an immediate alert to decision makers. To maintain this integrity, the engine follows a strict data entry rule. An input is entered into the model once, and all subsequent occurrences link back to that single source cell. Solving backward from a centralized dashboard ensures every calculation serves a specific business question, keeping the structure aligned with management's objectives. A professional model does not weigh all operational variables equally, as treating every data point as a priority can dilute management focus. Instead, analysts separate the noise from the signal by focusing on key value drivers, the specific inputs that dictate shareholder value. A true value driver must meet two mandatory criteria. It must have a significant mathematical impact, and it must be controllable by management. We can visualize the triage of these inputs using a value driver matrix. For example, commodity prices may have a high impact but low management influence, marking them as factors to monitor rather than manage directly. Conversely, inventory turns rank high in both categories, making them a primary driver for active management. These drivers are categorized into growth, efficiency, and financial buckets, and are isolated on a dedicated assumptions tab. Isolating these drivers focuses executive attention on the specific operational levers that create measurable enterprise value. Once the drivers are locked, the physical build phase begins. This is where the core engine projects the income statement, balance sheet, and cash flow statement into the future. Institutional standards require strict color coding. Blue font is used exclusively for inputs, while black font signifies formulas or links. This visibility helps identify partial inputs, where a hard-coded number is typed directly inside a formula, which compromises the audit process. Modifiers like a 5% increase must be pulled out of the formula and replaced with a clean, trackable cell reference. Formatting preferences like using brackets for negative numbers and simple dashes for zeros further aid in rapid, accurate reading. As seen in this profit summary, these visual rules result in a professional output where precise indents and minimal clutter allow for immediate review. To manage complexity, models rely on modularity. Specialized calculations are stripped out of the main statements and placed into dedicated schedules. Adhering to these hygiene and modularity standards ensures that the final model functions as an auditable, institutional-grade financial asset. These modular schedules rely on standardized architectural patterns to track financial changes over time. The most common is the Corkscrew schedule, used for tracking rolling balances such as long-term debt and retained earnings. The pattern follows a consistent mathematical flow. Start with a beginning balance, add capital expenditure, subtract depreciation, and sum to reach an ending balance. That ending balance then flows directly into the beginning balance of the next period, repeating the cycle. The second major formation is the waterfall, typically used in depreciation schedules to track cohorts of assets. By utilizing years on both the horizontal and vertical axes, the waterfall calculates depreciation for assets expected to go into service in staggered future periods. Standardizing these geometric structures ensures that complex debt and asset life cycles remain readable and transparent to any professional reviewer. Even a perfectly structured spreadsheet is ineffective if its projections are divorced from external market realities. To validate the internal logic, analysts perform a comparable companies analysis, or CCA, which provides an empirical benchmark for valuation. Building a valid peer group requires strictly defined criteria. Peers must align by industry, market capitalization, and operational scale. Geographic factors also play a role, as macroeconomic trends like GDP directly influence the valuation multiples of the peer group. Once the peers are selected, analysts normalize their earnings, stripping out non-recurring items to create a clean financial comparison. Using these normalized figures, they benchmark the target company's trading multiples, like enterprise value to EBITDA, against the market average. This process anchors theoretical internal projections to empirical market realities, ensuring the model's engine operates within the context of the current economy. Despite precise internal structures and market data, the future remains uncertain. Professional analysts manage this uncertainty by abandoning single-point predictions in favor of stress testing the model. The first tool is sensitivity analysis, which studies how the outcome of a decision changes when a single input variable is varied. The second tool is scenario analysis, which assesses the effect of changing all input variables simultaneously to model different future events. This allows analysts to instantly recalculate the model for a worst-case scenario, accounting for simultaneous shifts in tax, volume, and margins. Stress testing reveals the model's structural boundaries, allowing executives to visualize the risks associated with a project before capital is committed. Isolated value drivers, normalized peers, and stress-tested scenarios all funnel toward the final valuation. The primary output is the discounted cash flow, or DCF, which establishes the intrinsic enterprise value of the business. For investors, the bottom line metric is often the multiple on invested capital, or MOIC, which determines the final return. These financial models provide a robust, flexible architecture to navigate high-stakes corporate uncertainty, improving stakeholder confidence and delivering real business value. Replacing guesswork with engineering allows decision-makers to evaluate risks and opportunities with precision when capital is at stake.